Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's Thursday, the 15th of December, and we have our regular Thursday guest, David Kuo, founder of the Smart Investor, with us today. David, great to have you here as always.
Selamat tengah hari, down day Thursday, yeah?
Down day Thursday. Last week bucked the trend, but it's really down day with the sea of red today. We'll go through the numbers and we'll come back to you with your insights. We start with Bitcoin, which is 17,704. It's down 0.44%. Ethereum is at 1,290. It's down 2.2%. Now, looking at regional stock markets, we start close to home. David, to you, the Straits Times Index is down 0.39%. Bursa Malaysia is down 0.35%. Shanghai is down 0.31%. The ASX All Ordinaries is down 0.58%. The Nikkei is down 0.45%. The Hang Seng is down 1.3%. And rounding up the numbers, we've got the Kospi, which is down 0.23%. David, it's a sea of red. Tell us why.
I know, yeah. Clean sweep, full house, all down today. There's no reason to be cheerful, but I think it's just a case of follow the leader. America was down and it was up, first of all, and then it reversed and it went down after the Federal Reserve announced that they were going to increase interest rates. No big surprises there, but I think really sort of what worried people was how long are these high interest rates going to persist? And I think there is a spillover effect over here in Asia. And also we had some pretty disappointing numbers from around the region, particularly from China. So it's not entirely surprising. Maybe the Santa rally is not going to happen. Maybe Santa has delivered his gifts already and he's putting his feet up and going to sleep now. So no expectations for a huge Santa rally between now and the end of the year.
Now, David, I want to drill down on a couple of things. First thing is the messaging that the terminal rates will be around 5.1%. We're at about 4.5% right now after the latest rate hikes. So that doesn't suggest a lot of movement upwards. But we still have the inflation number in the high sevens. How believable and realistic is the 5.1 number?
Well, it really depends. I mean, there are two things that need to happen. You're right. I mean, inflation has come down from 7.7% in October to 7.1% in November. So, yes, it's moving in the right direction. And maybe the Federal Reserve thinks that it will carry on moving downwards, which therefore means that it doesn't have to increase interest rates that much more. But you are right. There is a gap between the inflation rate, which is still at 7.1%, and the Fed fund rate, which is 4.5%. So does that mean that if the Fed carries on the way that it has in the past and it increases interest rates by another half point, then it's another one and done? That remains to be seen. The problem with inflation, Brian, is it's a bit like driving a car. I mean, anybody who's driven a car on a motorway, an autobahn, or the highways in America, you're driving at 77 miles an hour, 7.7, and then you're down to 71 miles an hour, 7.1, and you're actually in a 20-mile-an-hour zone. And you're saying to the traffic cop, it's fine. My speed is actually coming down, so therefore it's okay. And the speed cop says, but it's a 20-mile-an-hour zone, and you're at 7.1. You're at 71 miles an hour. I'm afraid I'm gonna have to give you a speeding ticket. And I think people are going to call the Fed to order here, and they're going to say, look, how are you going to get to a 2% inflation rate when you're only having interest rates at 5%? It just doesn't make any sense at all. And of course, you have superimposed on that the unemployment rate at 3.7% over in the US. And with such low unemployment rates, the workers feel as though they have a huge amount of bargaining power. And they're going to say to their employers, well, I'm going to have to ask for more pay. And of course, as you know, Brian, if you ask for more pay, that's going to feed into the interest rate spiral.
Absolutely. Now, David, you also alluded to another reason why markets are down today, really data across the region has come out rather poorly. So China's November retail sales were significantly missed the targets. South Korea's revised trade data showed slightly narrower trade deficit. Japan's trade data, however, it also had a wider trade deficit. And then we look over to China, and then we have China saying that they're going to stop reporting on COVID numbers. So all of this is the Asian picture right now, which obviously then spooks markets a little bit. What are your thoughts on this, and what's the Chinese strategy?
Well, I think we can tie both Japan and Korea to China's slowing economy. Because of China slowing down, it therefore means that it's going to be buying less stuff from these industrial powerhouses such as Korea and also Japan. So that kind of explains what's going on with those two economies. But as far as China saying that it's no longer going to be reporting COVID figures anymore, I don't think anybody is hugely surprised. I mean, even when the numbers came out, and people said, "Oh, so the number of COVID cases is 20,000." People are just going, seriously? I mean, they're just laughing at those numbers, and they're saying 20,000 out of a population of 1.4 billion people. I mean, that is just a head scratcher. So China is now saying that it's no longer going to be reporting the COVID numbers, and I think it's called the ostrich technique. Yeah, when there's trouble around, you just go and dig a hole in the ground, put your head in it, and say, we're not going to be looking at those numbers anymore because they are kind of meaningless. And everybody knows they're meaningless. But what is the strategy? I think that is the interesting thing. What is China's strategy with regards to COVID? Is it just going to let the virus let rip? Because, I mean, they kind of know that their vaccines don't work particularly well. And so maybe they're just saying, the fittest will survive. So we'll just let the virus rip through the country, and those people who are going to catch COVID will either live or maybe they're going to meet their maker. And that is going to be their strategy. It is a very worrying strategy. And the reason why I say it's worrying is because if you have a virus in an incubator in a country as large as China, I mean, this virus is going to run riot. It's going to mutate. It's going to do all sorts of things. And I really worry that we're going to be getting a repeat of what happened, 2 years ago, where the virus is going to be allowed to mutate and multiply, and then it's going to go out into the world again. And I do worry about that. And I just wonder if China is making the right decisions right now. Clearly, the economy is slowing down, and they're saying that unemployment is rising in China. The economy is slowing down. People aren't going out and shopping, partly because they haven't got the money to go out and shop anymore. So it is a very worrying time, I think, not only for China, but for the rest of the world, Brian.
Then how is this going to impact currencies, particularly the US dollar, which has been weakening significantly recently?
Yeah, I know. Yeah, I mean, this is also another head scratcher. Sure, I mean, the DXY, which is a measure of a basket of the US dollar against a basket of currencies. I mean, that peaked at around 115. Now it's around sort of 105, 104. So the US dollar has clearly weakened. But what I urge people to do is don't speculate on currencies, because it is the easiest way to lose money. Because don't forget that you are not betting against a weakening US dollar. You're also betting that other currencies are going to strengthen against the US dollar, because things work in pairs. I mean, a currency just doesn't appreciate by itself. It has to appreciate against something else. So my outlook for the US dollar is, I think it's going to remain relatively strong, but against what, I don't really know. And don't forget also that it's a function of the interest rate differentials between the US and another economy. And if another economy decides it wants to jack up its interest rates, then of course it could strengthen against the US dollar. But you're betting on a number of factors, and it is really, really difficult to call. So I'm an investor. I invest in US stocks. Do I try and sort of cover my US stocks with kind of currency trades? No. I just think I control the things that I can, and I forget about the things that I can't. And all I care about is whether or not a company is going to do well, And in the past, when the US dollar was high, a lot of companies were saying that when they translated their earnings back into US dollars, it would have an effect on their profit and loss accounts. But as long as the company is still selling stuff, that's all I care about. I don't really care about that currency exchange at all, Brian.
Now, on that note, David, thank you very much for your insights. Thanks for coming on the show.
You're welcome.
Now, we've been speaking to David Kuo, founder of the Smart Investor Singapore, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.